Good morning. I'd like to start with thanking all of our local nonprofits, as well as the nonprofit organizations around the country and around the world, and their donor bases for what they are doing right now. I know we are all trying to find ways to serve our communities, our families, the world at large during this time of physical, financial, emotional, and psychological, and all the other stressors that are out there. The way we have come together and pressed into the deep recesses of our resources and shown up at this time is truly bringing out the best of us. My name is Danielle Howard. I'm a certified financial planner, and I've called the Roaring Fork Valley in Colorado my home for over 35 years. I've been walking alongside people on their financial journeys for over 25 of those years. I'm a financial life planner, wealth manager. I embrace sharing as part of that journey as we look at using our time, our talents, and our treasures as we bring the world together and look at what creating healthy financial lives is all about. Our time together today, we're going to be looking at where we are at with philanthropy, how elements of the CARES Act and the SECURE Act can benefit organizations and their donors, and open up opportunities to move forward in the philanthropic space. I am going to cut my video out and share my screen. With the live version of this, we're going to answer questions as they come up, and we'll answer them at the end. I am recording this, and so if you're watching this as a recording, it is not going, we won't be able to answer questions, of course. So I am going to stop my video, and I'm going to share my screen with you, and we will dive into this. I'm not too sure on the recording if you're going to be able to look at this from the standpoint of moving my face around to if it's intruding on your visuals. So minimize it if you can. What are we looking at? Where are we? I do believe that we are at a place where we have a moral imperative to co-create a new and better world. I truly feel that in the midst of all of the challenges, the pain, and the horrible suffering that is going on right now with the COVID-19, that it is happening for us and not to us. I believe that as we look at how to give generously to causes and organizations, as well as to our next door neighbors, that it is no longer just a luxury of abundance, but moving forward, it is an expression of our sufficiency, our enoughness. Let's look at some of the challenges that we're facing right now. In the world of philanthropy and charitable giving, I think we need to look at our temperaments and the financial techniques that we're utilizing. We have an opportunity to move from that scarcity mindset of I don't have enough to give, or I'll give when if there's something left over, to understanding that we all have enough and we are enough, and that we can create a you, it's no longer a you or me world, but as we draw together, it is a we world. We're going to be challenged with our motivations around giving, as well as the conversations, whether it's with family members or our financial professionals. What motivates us? What has motivated us in the past to give? What conversations have we had? What has worked? What do we want to do differently? These are some of the challenges that we are facing. Our opportunities. What we have seen happening in COVID is an outpouring, a creation of collaboration in new ways that we might not have seen before. We are learning that we can build on, these opportunities. And we want to, figure out what is working and continue to press into it. When we have looked at giving, if there was something left over, we've had this time now to go, wow, lots of things have fallen. Sorry about that. We are looking that many things are falling away, and we're focused on what is truly important. We're looking that we need to stay in touch with the upcoming, with the changing legislation and what's happening in Washington, D.C. And what are the financial tools that are out there that could really help either leverage our giving or help us from a tax advantage than when we're aligning things with our heart and doing it differently. I think we are going to have this opportunity again to look at money and talk about it, whether it's between spouses, family members, professionals. It is in the process of changing, and I think we have a lot of opportunity there. Let's dive into some of the elements. With the CARES Act of March 27th, 2020, over $2 trillion has been pushed into our economy for economic relief, for families, for businesses. This is the largest influx of governmental money that we've ever historically experienced. And how is that going to change what we do and how we do it? Let's dive into what itemized deductions around charitable giving, what has changed there. We know that as taxpayers, we always have choices. In the pre-COVID world, cash gifts to public charities were deductible in the year donated and were subject to a limitation of up to 60% of your adjustable gross income for both individuals and couples. And if you were a corporation, it was 10%. And this again is a cash gift. With the CARES Act, this has changed. Taxpayers can now give, the 60% cap has been lifted, and a donor can fully deduct up to 100% of their gift off of their adjusted gross income. And it has increased from 10% to 25% for corporations to give cash. Now this is only cash contributions only. Gifts are limited to public charities and certain foundations. And this 100% deduction does not apply to gifts made to your donor advised fund. The standing on giving of appreciated gifts, this is where if you had invested assets that had appreciated in value or had a business that you wanted to give away a percentage of the ownership or even livestock. There's a variety of things that you can give away very creatively out there. But that has stayed, that appreciated assets is only deductible up to 30% of your adjusted gross income. But the donor advised fund is still a way that you can get those appreciated assets contributed into and vetted towards your nonprofit of choice. So here's an idea. If you received the economic impact payment of that $1,200 per person, and you don't need it, you can create a win-win-win opportunity. This EIP is technically a tax credit to offset your 2020 federal income taxes. So you will get that tax credit, dollar for dollar reduction of your tax liability. That's a win. You will win if you give it all away and are doing an itemized tax deduction this year. The charitable organization wins. You give them something that is much needed right now. Also want to let you know that you can go big this year. If you make a large cash donation this year in excess of your adjusted gross income, you will be able to carry it forward on your tax return. Here's another win for donors. Let's take it combining a Roth conversion. Let's pair that Roth conversion with a charitable cash gift to create a tax savings powerhouse. The stars are aligned right now to make 2020 a perfect year to consider a Roth conversion. Why would you want to convert some or all of your traditional IRA over to a Roth? Well, we know that traditional income, when you take it, comes to you as ordinary income. And we know that it is the biggest bucket out there and the government's biggest opportunity for taxation down the road. So if your IRA has pulled back because of the market, which in many cases is the situation right now, you have an opportunity to sell low in one vehicle and then buy low in a more tax efficient vehicle. The long-term gain in this is going to lock in your tax-free gains down the road. How about tax rates now or down the road? We know that right now we're in some of the historically lowest tax brackets we've experienced. We understand that with $2 trillion being influxed into our economy to prop everything up right now, somebody's going to have to pay for that, and it will be taxpayers of the future. I anticipate that our tax rates are going to go up down the road. So whether you are in a 22% tax bracket or a 33% tax bracket, 32%, 35, 37%, you could look at converting up to the next tax rate. It still keeps your taxes low, and you can convert and take as ordinary income from your IRA and then convert that over into a Roth. Another component here is to take a look at the tax rates for single versus married people. We know that you may be in love, but love doesn't last forever. And that if you have a spouse that is going to inherit your IRA, you can see that tax brackets for a single person, the rates go up at a much lower income level. So if you were to convert your Roth now while your tax rate's on a higher income level, pay that tax, convert it to a Roth, then when your spouse is alone, they will be able to take those funds income tax free, and they won't be impacted by getting bumped into higher tax brackets because of taking the income from the IRA. You also have more buckets to choose from. When you convert some of or all of your IRA into a Roth, you are going to, my goal is to help people look at which buckets do they want to turn on the spigot from based on tax environment, economic environment, life situations. And the more buckets you have to choose from, the more options for income you have down the road. So creating a robust Roth bucket is a good idea. Why might you not want to convert into a Roth? The idea that you would deplete your liquidity to pay the taxes. And if we combine this with a charitable gift that is a 100% off of your AGI, you could use the cash to pay for to utilize the charitable gift, which means that would offset your taxes due. So you want to be careful about what cash you have on hand and play this out. But you can give cash to charity which offsets the taxes because we've got that 100% tax deduction this year. And then do the Roth conversion. And because you have the deduction with the charitable giving, you would have a tax savings powerhouse. But we want to make sure that that liquidity is available to you. We want to look at your tax brackets and implications with Social Security and Medicare. We may want to compare a charitable remainder trust of your IRA as a beneficiary, and that might be a better option rather than the Roth conversion. And it may increasing, you know, if you were to make a Roth conversion and the charitable gift didn't completely offset your tax, it could possibly impact your personal stimulus. However, you've probably already received your personal stimulus, so I'm not too concerned about this one at this point. We also have the opportunity this year to defer your required minimum distribution for 2020. There's considerations to make here too. And again, you need to be working with your professional advisors to look at what your situation, what is best for your particular situation. You would want to look at the asset allocation of your holdings inside your IRA. You know, again, so required minimum distribution, if you were 70 and a half last year, you have to take that RMD. That changed with the Secure Act, which we'll get into in a minute, but you do not need to take a required minimum distribution until you're 72 if you didn't hit 70 and a half last year. Confusing? Yes. So if you are required to take that required minimum distribution for 2020, and you had more of an equities focused in your portfolio, and you've experienced that pain of the pullback, you may be exposed to what we call sequence of return risk. And it's a consideration for you to not take money out of your IRA this year and let your portfolio recover. Again, unless you're considering a Roth conversion, then now is the good time to do it. This is kind of a separate idea. If you need your cash flow, you know, if you need money right now, we need to take your RMD for 2020. If you need cash flow and you also think you're going to be in a higher tax bracket down the road, again, you may want to take at least your RMD for this year. If you are philanthropically inclined, though, here is an idea. We've got the qualified charitable deduction, which has been in place for the past several years. And the idea behind the QCD is that you can give your required minimum distribution directly to charity. The idea is that instead of giving it in 2020 when your account value is down, because the CARES Act gives you a reprieve from taking that RMD, that you could push your qualified charitable deduction into 2021. You can potentially recover get the recovery on your portfolio. And if you take it in 2021, it will lower your taxable income in 2021. It will probably, because it goes directly to the charity and does not show up on your tax return, it may lower the taxation on your Social Security, as well as potentially lower your premiums on Medicare. Again, you must be 70 and a half or older to take your RMD and to do the QCD. You could move up to $100,000 over to the qualified charity and use the qualified charitable deduction. You cannot use a donor advised fund. It is not a qualifying charity. You would have to find a qualified 501c3, and the donor advised fund does not fit that bill. You want to make sure that your CPA knows that a qualified charitable deduction was made, because you cannot both make the qualified charitable deduction as well as the itemized deduction. The check must come from your custodian, whoever is holding your IRA, and go directly to the charity. Just another idea on how the CARES Act could be working for you. The standard deduction, you have a choice of whether you itemize or take a standard. The CARES Act implemented the universal deduction, which is great for smaller givers. This is going to allow you to take $300 if you are an individual, or $600 if you are married and filing jointly, right off the top of your tax return. So this would be if you are taking the standard deduction, and this will come off of the first page. So it's just a nice, easy, everybody's going to probably be able to avail themselves of this. So make sure that you get a check to charity of your choice, and you will get a deduction right off of your taxes. In our state of Colorado, we have the opportunity to participate in Refund Colorado. The CARES Act has given us the tax filing extension deadline of July 15th. And if you've not filed yet, and if you were going to receive a refund on your Colorado return, consider, writing the name of the 501c3 into the line on your tax return, and your refund will go directly to them. You want to check with your own state to see if they have something similar if you are not living in our gorgeous state of Colorado. Let's take a look at the Secure Act. This legislation was passed into law on December 30th, 2019, setting every community up for retirement. It has many moving parts that impact pre and post retirees. And today we're just going to focus on the charitable planning opportunities. Again, we want to look at the difference between itemizing your return and looking at a standard deduction. The passage of the, when we changed the opportunities to, they doubled the standard deduction and cut out a lot of things in past legislation that allowed you to take your itemized return. And so the bulk of people are taking standard deductions nowadays. However, if you decide to use a lump and clump strategy, that can be very powerful. Let's take a look how this works. The idea behind it is that you would clump your charitable giving into 1 year in order to utilize the itemized deduction. And then the next year, go ahead and take the standard deduction. Here's an example. Married taxpayer in their early 60s, they have no medical expenses. They're limited on their state and local tax deduction to $10,000. They had a mortgage interest of $11,000, and they normally gave to charity about $2,500. Their total itemized, if they were to choose to itemize on their return, would be $23,500. These guys would be better off taking a standard deduction, and they wouldn't have any benefit of that charitable donation. If on the other side, they decided to utilize a donor advised fund and lump their charitable giving into 1 year, and they had the 0 medical expenses, the same 10,000 state and local tax limitation, the mortgage interest of 11,000, and they put $10,000 into a donor advised fund, their total itemized deductions would be 31. And that would be a nice little offset to their taxes. The donor advised fund then allows you take the deduction in the year you make the contribution to the donor advised fund, and then you could give $2,500 in future years to whatever charitable organizations you want. You can spread out your gifts to charity moving forward. And the next year you would go ahead and take your standard deduction. Another idea to look at creative strategies. The next thing we're going to look at is the IRA. So the Secure Act killed the stretch IRA. It is no longer available to non-spousal beneficiaries. This was a tool that allowed non-spousal beneficiaries to take out the required minimum distributions based on their lifetime. Therefore, you stretched the tax-deferred growth of the IRA, and they were able to have a little spigot and get a drip of ordinary income over a longer period of time. So because that went away, you could look at the idea of how to replicate that stretch. And if you're philanthropically inclined, this is a good way to benefit not only your family or cared ones, but to get money to your favorite organizations. What you can do is replicate the stretch. This is where you would name a charitable remainder trust as the beneficiary of your IRA. It's a testamentary gift, so your IRA would move into the charitable remainder trust upon the death of the IRA owner, and it's an income tax-free transfer. Then you have your heirs named as income beneficiaries. You can determine a time frame that you can name 10 years, 20 years, or a lifetime of your heirs. And at the end of their life, or the end of that period certain, the remainder would go to the charity. You need to choose a trustee. You can choose a corporate trustee. You can choose a charity. You can use a donor-advised fund to be the beneficiary of your charitable remainder trust. And you can change that at any point while the donor is still alive. You can also decide how much you want to go to the charitable remainder trust. It can be all or part of the IRA. So where are we headed? I am really excited about where philanthropy and giving is going. Our new now and moving into the new normal is opening doors that we have never seen before. We have choices to make. We get to be proactive instead of reactive. And we can prepare instead of always trying to repair. We can create durable, long-term, sustainable philanthropic giving. We are building new mindsets around giving as part of a healthy financial life and understanding that giving is key as we experience happiness. We can understand and embrace the ever-changing tax, economic, and life environments and how best to apply the strategies and tools to optimize giving. We can do our dollars differently as we open up new lines of communication with our family members, with professionals, and with charitable organizations. Within our nonprofit organizations, I think we have a huge opportunity to look at our foundation and look at that long-term sustainability, where you can create investment policies and create portfolios that align with the integrity of your core mission. Instead of just, an asset allocation based on, the latest benchmark, you can really drill down on what is your core mission and look at the investments you have within your foundation and work with investment professionals that will help you align your mission with your investments. For donors, take a look at how you can optimize your giving. You can learn more about what we're doing at Wealth by Design. We're the expedition leaders for people who, as David Brooks in his book, The Second Mountain, A Quest for a Moral Life, are fiercely committed to climbing their second mountain and living lives of meaning and purpose. We work with a limited number of people who really want to optimize their financial possibilities and life potential. For organizations, we can help you educate your donors to the philanthropic mindsets and financial modalities to optimize their giving experience. We can also talk to you about our relationship with SEI and their institutional outsourced chief investment officers as an opportunity to tailor your investment management and your foundation dollars. I want to thank you for taking the time to listen, for taking the time to learn, for taking the time to say game on and bring it to the table right now as we show up and press into this season of uncertainty. I encourage you to continue to live generously. I appreciate your time being here, and just say a quick goodbye and let us know how we can walk alongside you and serve you in your philanthropic and your giving potential.